Hi, my name is Arkadiusz Trzciołek. I am a fixed income strategist at PKO Bank Polski.
We expect that after a volatile period since March, the Polish sovereign curve will stay broadly stable in the remainder of the second quarter of this year. In our forecasts, we assume that 2-year, 5-year and 10-year bonds will finish the quarter around 0.70%, 1.10% and 1.45% respectively. As it is a case for a majority of countries globally, Poland has increased its debt supply to finance programs oriented at mitigating the crisis caused by COVID-19 pandemic and lockdown of many branches in the economy. The supply of debt instruments is coming not only from the Ministry of Finance, but also from state-owned entities, which bonds are fully guaranteed by the Treasury. The fiscal response from the government has been matched by the central bank as well. The monetary conditions in the coming months are likely to stay loose. After recent cuts, the Monetary Policy Council may stay on hold, however, the bank will continue its asset purchases program. Recent data releases remain gloomy, as although Polish GDP remained positive in the first quarter of 2020, it will turn negative in the second quarter, likely showing a double-digit decrease year-over-year. Nevertheless, data releases are somewhat overshadowed by swings in investors' moods. As the stress on financial markets eased slightly, Polish asset swap spreads narrowed from its March peak. The fiscal response to the coronavirus-related recession called for a large stimulus towards citizens and companies. This resulted in a large bond issuance to finance the newly introduced programs. The stock of government bonds increased this year in January to May period by over 70 billion zloty, whereas a year ago the increase was only 20 billion. Additionally, debt authorities resumed treasury bills issuance, which were not issued since February 2017. On top of that, the issuance of state-guaranteed bonds, which are sold by PFR, the State Development Fund, and BGK, the State Development Bank, totaled 80 billion in April and May only. Each PFR and BGK plans to issue 100 billion zloty to finance special pandemic-related programs. As the 2020 budget did not envisage large increases in government debt supply, the borrowing needs are likely to increase. The Ministry of Finance has already hinted on 100 billion increase in borrowing needs, which were initially budgeted slightly above 140 billion. The budget, which called for zero deficit in 2020, is likely to be revised in July and is likely to show a deficit. Monetary conditions in Poland eased significantly, as in March and April the Monetary Policy Council cut rates twice, each time by 50 basis points, taking the reference rate to 0.50%. Additionally, the market is still pricing in rate cuts in Poland. Recently, the derivatives contracts suggested a scope for rates to be cut close to zero as soon as mid-2020. On top of rate cuts, the National Bank of Poland introduces its own asset purchases program, where it already bought 71 billion zloty worth of securities. Initially, the National Bank of Poland bought mostly government bonds, which constitute some 70% of total purchases. However, recently, the authorities are also purchasing the state-guaranteed bonds. Lockdowns imposed in majority of countries worldwide to fight COVID-19 pandemic resulted in a sharp deterioration of data releases recently. In Poland, GDP in the first quarter remained positive in year-over-year terms, however it is likely to show a double-digit decrease in the second quarter, as suggested by gloomy industrial production and retail sales data. Nevertheless, despite weak releases, the easing of lockdowns and strong fiscal response from authorities improved sentiment. Polish asset swap spread narrowed sharply, moving in 10-year tenor from peak close to 100 basis points to roughly 45 basis points. Moods in Europe improved following the Franco-German proposal on the EU-wide recovery fund, which calls for bond issuance by the European Commission, and help inform grants to countries most affected by the pandemic.